So starting off, we're going to be looking at what we can see with regards to crude flows, crude exports, what's happening with the OPEC plus agreements and how they are reacting to this crude oversupply. Then we'll move on to some more of the kind of the crude and product demand elements and what we're seeing there in the US and around the world. We'll move on to some other commodities that we look at as well, just in terms of what kind of nuances can we gather, what insights can we gather from, say, the LNG markets and from the bulks markets in terms of the response to COVID-19 and how we're kind of easing the various restrictions and how the economies are getting back up to speed. And then I'll finish off with a section looking at crude inventories, both onshore and offshore, and then looking at what's happening in the product markets with the floating storage situation, the oil and water situation there. So I'll hand you over to Omayoun, who's going to start off for us looking at the crude supply picture.
Thank you, Alex. Thank you, Arthur, for the introduction. So indeed, I'm going to take you through supply behaviors with a focus on OPEC and all what happened in the past few weeks. I'm sure you have followed the news and the very strong rebound in prices with WTI now already above $30 a barrel. But the question is this really supported by a change in physical markets and in supply? So I'm not going to be mysterious here. The quick and short answer is yes. OPEC Plus so far has met its pledge. So in the past few weeks, we came up with a new tool that we call the OPEC Plus Compliance Indicator. The tool basically takes into account variations in exports of crude oil and condensate. We take a lag into account because obviously what you produce today doesn't get loaded typically on a tanker that same day. Typical lag is about 5-6 days. So this is what we've taken. In addition to this variation in exports, we've also kept an eye on what's going on at the inventories level, because otherwise you could argue that if exports fall massively and at the same time inventories jump massively, then in terms of production, you're probably flat. So that's for the methodology. Coming back to the results, again, it's been quite astonishing, to be honest. So as a reminder, OPEC Plus had pledged to cut about 9.7 million barrels per day of oil starting from the 1st of May. And what we've seen so far, so when I say so far, our number actually goes until the 17th of the month, 17th of May. And what we've seen so far is a 98% compliance as a whole for OPEC Plus to the deal. So what you're seeing on the chart here is how much is left to cut for each country in order to reach 100% compliance. So notably, you have countries on the left that are in red, meaning that they still have to cut, according to us. And on the contrary, on the right, you have countries in green, which basically means that they have been over compliant. So for instance, here you can see that Iraq, according to us, still has to cut about 500,000 barrels per day in order to be fully compliant. While on the other side of the chart, Saudi Arabia is already 1 million barrels per day, pretty much higher than its pledge. Actually, Saudi Arabia is already at the level it pledged it will be at the month during the month of June, because last week they've announced that they will add an additional 1 million barrel per day cut for the month of June only. So they're basically already there. Apart from Saudi Arabia, Russia, the other OPEC Plus leader, has also been very active in its cuts. And that's a major change compared to previous deals where its compliance level generally was quite low. A last note on this slide that I wanted to mention, and I think it's quite interesting, and it's looking at Mexico, which you can see here on the right of the chart. So despite the country being so tough in its negotiations last month and managing to only pledge to cut about 100,000 barrels per day versus the 400,000 barrels per day that other members wanted it to cut, well, Mexico has actually been the most over-compliant member, with its production falling about 230,000 barrels per day since the 1st of May. So Looking at these numbers on the previous slide, except Saudi Arabia and Russia, cut targets are based on the month of October 2018. So this chart here on this slide here should give you a view of how big this decline has been compared to April, so compared to last month. So in terms of cuts, the nearly 10 million barrels per day cut represents about 10% of world supplies. And that's a very impressive decline on a monthly and a month-on-month basis. Even though this is based on a much higher production baseline for Saudi Arabia and Russia, if we compare that with their October 2018 production. So with this high level of compliance, OPEC Plus has kind of managed to restore its credibility in oil markets. So it's still too early to say whether the success in rebalancing markets is complete, but at least the organization now appears more as a credible and stabilizing force in the markets, while it seemed to be just the contrary only 2 months ago when Russia and Saudi Arabia both boosted supplies to record levels. And this is actually even more meaningful given that when we tracked OPEC plus exports of crude and condensate in the past 2 years, so looking at the previous OPEC deals, we were quite disappointed with the level of compliance to these previous deals. And really at the time it was due to US sanctions on Iran and Venezuela, and also the civil war in Libya that really allowed OPEC Plus as a whole to decrease supply. But here that's not been the case. So we've seen real strong compliance. So the question that we have right now is whether this will hold as prices increase and state oil companies are tempted to bring production back. So this would be something that we obviously keep an eye on in the next few weeks. And one last point on this slide, it's the fact that if you put this into wider perspective, such as the pre-COVID-19 period or 2019 exports on average, comparing to these periods, then the decline still is massive. We're talking about a 5 million barrels per day decline in exports, but obviously it's much less massive than the number that OPEC Plus is putting forward right now. So the last slide here, looking at OPEC Plus supply, we actually thought that in order to get the full picture, we also needed to take a look at what's happening on the product side. So the products exports and not just crude and condensate. And in fact, in May, this is a telling story as Saudi Arabia has massively boosted its exports of clean petroleum products. So this is what you can see here on the chart. That's the exports of clean petroleum products, CPP, out of Saudi Arabia on a monthly basis. And you can see that currently in May, they are standing at an all-time high of 1.5, almost 1.5 million barrels per day. And that's 300,000 barrels per day higher than the month of April. So this can be explained by the ongoing situation with COVID-19, and it's also in line with refineries restarting after a period of overhaul at the same time that domestic demand is diminished, including in Saudi Arabia. But nonetheless, it's telling us that the level of compliance can be relativized sometimes in some of these places where you could see production, so exports of crude and condensate fall, but at the same time, exports of products increase. And actually, we've seen the same thing in other countries such as Kuwait, Algeria, Nigeria, Equatorial Guinea. These 4 countries together have boosted CPP exports by 150,000 barrels per day. Actually, only Iraq, as a member of OPEC Plus, has decreased its exports of CPP by about 30,000 barrels per day. So ending on this note, I'll now hand over to Reed, who will take a look at how fast demand is picking up in the US and China. Reed, up to you.
Thanks, Hamayoun. Yeah, so indeed, I'm going to be shifting towards looking at liquids demand, both in the United States and then shifting to East Asia, and then finishing up with a global focus. So first, just shifting to US inventories. Obviously, we continue to touch upon this topic webinar to webinar, given the movement on the spot month contract that we saw last month. Thankfully, so far in May, things have been a lot more stable. Month over month, inventories are flat. We've seen draws in Pad 2 of around 7 million barrels, despite gains in PAD 3 and PAD 5 of about the same amount. And this has basically led to a situation where the United States continues to have available storage capacity of around 142 million barrels, including the SPR. You know, it's no surprise this is far under January 2020 levels, but this availability, like I mentioned, is pretty steady against April, and marks a big change. Just to put this in perspective, in April we saw an inventory build of 35 million barrels against end of March, and we clearly haven't seen that into May. So the positive is things have stabilized. Even just focusing in on Cushing, on a 14-day moving average basis, inventories are lower by about 5 million barrels within the tank farm. It is likely that much of this volume was just shifted to PAD 3 to make some room, given the way the WTI contract trades delivery into Cushing. But it's possible that some of this volume also found its way into refinery utilization. But you know, the takeaway here is inventories are stable. And if we go ahead and go to the next slide, we'll see here that if you look at the chart for May, these are US oil imports. They're up by a lot, right? On the month, we're looking at arrivals of about 2.8 million barrels per day, about a 700 KBD increase month over month. This is interesting, right? Because we've seen inventories in the United States hold steady, despite the fact that we've seen a big increase in imports. And this points to the clear supply destruction we've seen. You know, according to the EIA, production is down 1.5 million barrels per day since mid-March. So clearly, the large import increase has helped to keep inventory stable and kind of prevent declines, actually. And you know, everyone's been tracking the flotilla of barrels coming from Saudi. You know, these volumes are driving the increase on the month and the year. You'll notice arrivals from Saudi are so far holding at 810 KBD, which is nearly a 400 KBD increase against year earlier levels. That's a big increase and a big reversal in trends we have been seeing for over a year. And also Southern Iraq, volumes out of Basra have also found their way into the United States. Again, a lot of these Middle Eastern players are just looking for anyone who's willing to buy anywhere there might be storage space available over the past couple months. Now, like I said, the big key here is the increase in imports is really offsetting any decline in domestic production when it comes to domestic onshore inventory deltas. So things have stabilized, but for now, we haven't seen an increase in storage availability in the United States. And we'll see if that might start to happen in the months ahead. So shifting away from the United States, looking at China, obviously a big question given the fact that they are further along this timeline of COVID-19. And if you look at the chart, the orange line is domestic inventories. The blue bars are imports. Obviously, so far through May, imports are up by a whole lot, back towards historic highs. And despite this, domestic inventories have actually trended lower. End March, domestic oil inventories were at about 808 million barrels, and we've come off these levels slightly despite the fact that imports are up by a whole lot. I mean, clearly this is being driven by the fact that refinery runs are higher. The big question is domestic demand. And I would say we should be cautious about drawing a direct correlation between higher refinery runs and an improvement in domestic demand. There's no doubt that domestic demand for petroleum products is higher, but refinery runs are likely higher than domestic demand needs, given the fact that, like I mentioned in our webinar from about 3 weeks ago, Chinese gasoline and diesel prices have only been cut by about 25% year to date, compared to Brent spot, which is down by more than 50%. So, I mean, that's a nice margin that a lot of Chinese refiners are taking advantage of. But of course, this doesn't imply to real market demand. So it's important to keep in mind that the Chinese are likely building product stocks domestically. And if we go to the next slide, and we look at global clean product imports by region on a year-over-year basis, you'll notice that arrivals in total globally are still lower against your earlier levels by about 1.8 million barrels per day so far through May. You'll notice only East Asia is up against your earlier levels. And this increase is a result of arrivals into South Korea and China. This is interesting, right? Because you have likely a huge amount of refinery utilization in China, likely producing at above demand levels domestically. China is also importing clean products, as well as South Korea. This is, in other words, the recovery in East Asia is helping to drive product demand for now. And this really helps to highlight the delineation between kind of East Asian economic recovery, namely in China and South Korea, and rest of world. And clearly, rest of world demand is very weak. And the question is going to be moving forward, how quickly can demand start to come back online? I mean, when looking at the United States, demand for gasoline has come back very quickly. The demand for distillate has come back moderately, while jet has really struggled. And I think as we think on a global basis, it's important to keep in mind that it's going to be difficult for refiners globally to kind of deal with, one, a mixture of recoveries based on region, and then also kind of the mix of demand. So for in the United States, gasoline demand is going to come back has come back relatively quickly. Jet is really going to struggle. In places like Europe, middle distillate demand could come back relatively quickly. Jet could struggle, right? So it's important to keep in mind that this delineation, not only regionally, but at the product level, it's going to be difficult. It's going to be a difficult road to recovery for sure.
Moving on to look at some of the products across China and across Asia. First of all, looking at LPG. And we can see here our two lines representing 2019 and 2020 imports. And clearly, through the first quarter of the year, 2020 LPG imports were down versus 2019. Now, the reasons for that, we don't need to overstate. Obviously, COVID has had a significant impact in terms of consumer demand for end products, i.e. microwaves and televisions and so on. But at the same time, we've also seen decreased activity on the petrochemical side, and in particular on propane dehydrogenation. It's fair to say as well that we've seen some naphtha substitution, certainly over the first quarter, and all of these factors have resulted in 2020 imports of LPG being below 2019. Now, I want to draw your attention to a second point of interest, and that's the small green wedge that starts to emerge at the start of April and grows from the middle of April onwards. This green wedge represents imports from the United States. And as you can see, they've clearly grown significantly. Incentivized by price, traders look to arbitrage in order to bring product in, to bring LPG into China. And at the same time, the Chinese government was attempting some sort of rapprochement, some sort of easing of their tense relationship with the White House, and as a result, encouraged imports from the US. Of course, if imports from the US increase, but the total volume of LPG imports into China is down, then someone must be paying the price. And what the Kpler data tell us is that the UAE and Qatari barrels have been supplanted by US barrels. And those UAE and Qatari barrels are now finding homes increasingly in India and Indonesia. Moving on to look at ethylene, we can see we've got quite a divergent line at the start of the year. And our ethylene imports into China in the first quarter were higher than both 2018 and 2019. And that stacks up with the earlier story that I mentioned around Chinese refinery runs. There was simply less domestic ethylene produced, and as a result, Chinese imports had to increase. As we get into April and May, however, we start to see a slowing in those ethylene imports. Domestic production increased as a result of higher refinery runs. Therefore, there was less demand for imports from the rest of the world. Why is this significant? Well, it's significant because China is the world's largest importer of seaborne ethylene. In 2019, for example, it imported 1.38 million tons of ethylene, 37% of the total. To give you some perspective, the country in second place, if you like, in that league table was Belgium, which imported around 500,000 tons. Now, the impact of this, the result of this, is obviously reduced cracker margins around the world. So that will affect crackers running ethane in the US and crackers running naphtha in Europe and Asia. And speaking of naphtha, my next slide shows the story of East Asian naphtha imports over the start of this year. And just to clarify, East Asian in this context includes Japan, South Korea, China, and Taiwan. And as we can see, until about February the 9th, we had a generally familiar path. We tracked previous year's import levels. Subsequently, however, we see a divergence of the levels between 2018, 2019, and 2020. The 2020 import level into the region is higher than 2019, but lower than 2018. And again, that stacks up with more domestic refinery production in China, producing more naphtha for petrochemical plants. And if we look at April in particular as an example of how much that impact has been felt across the region, we see that 30.3 million barrels were imported in April, which was 15% lower than the 3 months prior moving average. Now, obviously, this leaves a surplus in the structural flow of arbitrage naphtha to Asia. Where does it go? Well, the Kpler analysis tells us it's going into Japan and Korea, and in particular into Korea. Korea had a drop in demand in April, in line with seasonal maintenance and also in line with the peak of the COVID impact. But in May, Korean imports have recovered very, very strongly and are up 94% year on year. Another impact of Chinese import reductions, decreases, is on Russian Federation imports, which are down by over 50% in May versus the first quarter of 2020. So clearly that impact of increased runs and reduced imports is being felt much more widely. Now, on that note, I'm going to hand over to Alex, my colleague, who's going to talk about LNG and also about the wider situation with dry bulks.
Thanks, Reid. Hello, everyone. So yeah, let's focus a little bit more on China and India. So if we go to our chart, we can see that we want to highlight here India and China LNG and thermal coal imports. So we see that there has been a huge decrease actually in terms of thermal coal imports in April for both countries, that even accelerated in May. That come after an increase of imports in February, but of course, year to date, we have a huge decrease of thermal coal imports for both countries. So of course, it has been driven by a lockdown that came more recently in India. Although China used some more domestic coal, but here we wanted to highlight that one of the key catalysts for us has been the huge decrease of Asian LNG prices, which came down by more than 80% in the last 15 months. Even if it increased over the last few days, it decreased much more energy prices than coal prices. And that helped some countries to switch from coal to natural gas. And that's what we can see actually in the chart. So the orange bar is the thermal coal, and in blue, you can see the LNG. So LNG actually increased for both countries in terms of imports compared to last year, and it decreased in May, but of course in a much lesser extent than what happened in the thermal coal. So that catalyst, so lower LNG prices, also had some impacts around the world, but we will see that later in one of our slides. As a reminder, just wanting to highlight that actually Indonesia accounts for more than 60% of thermal coal arrivals for both countries, even if it decreased from 65%. So now if we move to iron ore and focus on China, it's worth mentioning that we see a rebound, an interesting rebound of demand of the last few weeks. So on that chart, there are three metrics. The first are the iron ore inventories, which decreased by 10% so far this year, and even 20% if we compare to Q1 of last year. The imports has been broadly stable. It increased in the first part of Q1, but then it has been stable. And last but not least, the daily steel production, which actually is increasing in China and even accelerated over the last few days. So altogether, the three metrics indicate a robust rebound in demand. As a result, of course, iron ore prices increased above $90 per ton yesterday. And we see this production acceleration of China also linked to the current tension between China and Australia. As you probably saw it, China announced this morning an anti-dumping and anti-subsidy duties for 80% on Australian barley imports as from today. So we can see there is more and more pressure between China and Australia, but China relies for 65% to Australia when it comes to iron ore. So of course, they're looking to produce more iron ore domestically, also because there are little option right now in the market, as you can see on the next slide. So even if right now there is a little disruption, we could see more in the next few weeks. So on the chart, just to mention the orange line, which is the global. So here we speak about global iron ore exports. Last year we had a decrease in March, but that was due to BHP and Rio Tinto stopping production because of the cyclone Veronica. So it was a one-off. But if we focus on 2020, which is what we want, we can see that there has been a seasonality for the export of global iron ore, and it's usually decreased in the first part of the month, and it increased again. That has been the case for both April and so far in May. But here, what we wanted to highlight is that Brazilian iron ore export decreased by 12% since the beginning of the year. That has been driven by lower shipment from Vale. But as you know, there could be some risk in Brazil regarding COVID-19, especially as the virus is taking hold in Pará, which produce nearly 35% of the country's iron ore. So Brazil is for us probably the country to focus on in terms of export of iron ore, especially regarding the tension between China and Australia. On the next slide, if we just come back on the LNG, as we discussed earlier, so the LNG prices decreased in Asia, pushed some players to redirect cargoes. So Qatar redirect some LNG cargoes away from Asia to Europe. So that's in black. It's a black line on our charts. You see that there has been an increase since February. It peaked actually in April. So far it's lower, but we're not the end of the month, so we expect this figure to be higher than what we have today. But here we wanted to highlight that we could see some kind of competition, some kind of market share battle between LNG players. Here we highlight US and Europe. So if we want to compare to the US, we can see at the chart, the yellow color, it's going much lower month after month. So since February, it's going lower. And as you know, Qatar probably has a much better break-even than US LNG players, export players, also regarding the increase of natural gas prices in the US, which is driven by a lower associated gas production. So here, as a conclusion, we just want to highlight that we are seeing a kind of market share battle in the US, and there is one other player which is also part of that game, which are the Russian, and so Russia is kind of like Qatar, having very low break-even for the LNG, and for the US players, it's much more difficult to bring the LNG to Asia, as of course the price is much higher than bringing that natural gas to Europe. So now I can hand over to Alex.
Brilliant, thank you, Alex. So I'll just wrap up looking at what all of this means to the crude and product storage picture as we see it. So starting off with crude, the chart here looks at floating storage barrels in the blue bars and onshore oil inventories with the orange line. So what you can see is we've seen a very small, and this was alluded to by Reid earlier, we've seen a very small decline in onshore crude inventories. In actual fact, looking at the data today as compared to when this slide was put together yesterday, it's pretty much flat in terms of May inventories compared to the end of May, compared to the end of April. Now, what this kind of flat picture shows is, or it masks this difference that we see in countries such as India, which have continued to build inventories. They're nearly 10.5 million barrels up on the month, with volumes going into their SPR facilities. And it also hides locations such as in the Caribbean, where there are pure storage terminals, or say in Saldanha Bay in South Africa, again, much more of a pure storage location. And we've seen builds there, and we still see vessels indicating, say, Saldanha Bay as a destination. So I think it would be premature to say that the crude build story is over. It's just taking a bit of a breather, as it were. If we look at where we've seen draws, again, they're in logical places. So we've seen a 6 million barrel draw each in China and Saudi Arabia. Now, that makes sense with what we're talking about, the increased crude runs in China. And it also fits with the really dramatic decline in production that we're noticing in Saudi Arabia, falling alongside the decrease in exports. So that's where we stand with onshore. But as you can see, we continue to build crude in floating storage. So we added a further 25 million barrels to date in May. So clearly there is still an issue with crude oversupply. Obviously, as we've alluded to, with the reduction in the OPEC plus exports, that's slowing down. But we are seeing this, this crude build. It's just quite a tricky picture, tricky story, where we will see this, I think, a gradual flow of vessels building offshore, then onshoring barrels, onshore inventories build, this kind of real ebb and flow, basically, between offshore and onshore. But then what do we see on the product side? Now, unfortunately, a global view of onshore product storage is essentially the kind of the holy grail for the commodities world. It's just not something that unfortunately we can put together at this point in time, and there isn't great data out there, if any really. But what we can look is what's happening on the water. So this chart looks at floating storage in the orange line and product on the water. So that's including vessels that are moving, which are the blue bars. Now, as you can see, despite these broadly global run cuts across the refining sector, we're still seeing an increase in floating storage barrels. So that's an increase in products which don't have a home to go to, basically. So clean product floating storage built by 38.5 million barrels through April. And to date, we've added another 21.5 million barrels in May. Now, it's interesting as well that the single biggest product that has built over this time period is gasoline, which added kind of as a product on its own, which added 21.6 million barrels since the end of March. Now, the timing of the builds offshore works with what we can kind of see, or what we saw happen in the crude world. Now, in crude, we can see what happened with onshore inventories, and we saw a significant build in March, basically in onshore inventory. So it started early before we then ramped up in terms of floating storage for crude in April and into May. Now, what we've seen in the product side is that ramp up in floating storage again in April and May, implying that the onshore storage is essentially full. Now, I'll just quickly kind of answer a question that we already had before we go to the broader Q&A section, because it touches on what we're looking at here. And the question was asking about, well, what about those increased Saudi exports that we've seen so far? Now, yes, they're coming from increase in refinery activity, as refineries are coming from turnaround. But at the same time, they're now higher than the kind of a stable level that we saw through 2019, which fits with a generally lower demand picture. And the question was really as well, where do we see that product going? Well, I think ultimately we're showing here that there isn't that increase in demand globally for clean products, and it's ultimately working into floating storage. So I'll just run through a quick bullets of what we've covered and some of the key takeaways here. Ultimately, OPEC Plus have had a significant cut in terms of their crude exports. We've not seen a significant, build in inventories in these countries either, implying that they are making great headway as a whole, i.e. Saudi, at cutting their production. The flip side is, though, that we have seen increased product exports, and that really is something that we, if the market is to rebalance fully, is something that kind of can't continue. We're seeing these tentative signs of recovery, some strength growing in the US, some strength in East Asia, but there is still this end question of what's happening with the product that's being built. We can't see what's happening in terms of product storage in Asia, in China. Is there real end user demand? Certainly when we looked in our session this morning at some more of the petchem elements in Asia, and it's hard to see where they are ultimately going into. If we look at the broader kind of macro signals from dry bulks, iron ore, again, that demand is picking up. The exporters, it's following broadly seasonal patterns, even if it's down slightly year on year. But obviously the geopolitical tensions are going to have a big part to play. And then it's what's happening in the LNG, and are we just setting ourselves up, or is the LNG market setting itself up for a kind of oil style market share battle between the trifecta of the US, Qatar and Russia? So with that, I'll hand you over to Arthur, who's going to moderate a few questions for us.
Yeah, thank you very much, Alex. Here we have indeed a question for Homayun. This is the following: how many vessels are being used as floating storage for both crude and refined products?
Yeah, so technically, if we look at all liquids, we're talking about 700 vessels, globally speaking. So this includes both. This includes all products, so crude, condensates and liquids, clean and dirty as well. We have seen in the charts, if we look at only crude and condensate, it's about 180 million barrels being stored in floating storage. Clean products, we've also seen it's about 75 million barrels. And in total, we're talking about 340 million barrels being stored offshore.
Well, thank you, Humayun. Do you incorporate inventory changes and refinery runs into your OPEC Plus compliance tracker? That question will go to Alex Booth. Alex?
Yes. So in the charts that we showed in the webinar today, we haven't included it. We've had this discussion around kind of, are we adding too much complexity when we're trying to tell the story around this? We certainly include onshore crude inventories in the tracker, and in the chart that you saw there, it takes that into account. But we are kind of separating out the product exports because whilst we think it's incredibly important what's happening there, it can slightly confuse the picture to put it all into one. But it is something that we will always be looking at that to take into account, basically.
Yeah, thank you very much. One question for Reid. Would it be possible for China to shift a significant proportion of its iron ore purchases to Brazil if trade tensions persist with Australia?
Yeah, good one. This is going to be difficult. The Chinese and the Australians are going to have to walk a fine line because obviously China takes the bulk of seaborne iron ore currently, about 80% of global volumes, and about 70% of what is exported comes out of Australia, right? So they could probably shift at max 30% of their demand to Brazil, but they're going to have to find a way to work with Australia if they want to continue to produce steel at the levels they are, because they don't have any other choice, right? I mean, Australia is the largest producer and exporter of iron ore currently globally. So it's going to be a difficult situation for both parties if they don't, if we continue to see trade tensions deteriorate. Obviously, you know, Australia does not have the flexibility of the United States or the EU, and that Australia does not have a large and integrated market. And so they're going to have to look to trade policy to make sure that they can continue to ensure that their supply chains are integrated. They can't just produce everything domestically and consume everything so easily. So the question is no.
Well, thank you very much, Reid.